Welcome to the Canadian Investors course, Session 10, Packaged Investment Products. Slide 2 contains the terms of use and disclaimer, which was read to you in full in the introduction. Please review it again. Session 10, Packaged Investment Products. Think of it as investments in a box. Clearly, if you didn't have any money, you wouldn't care about capital gains. If you have earned income, obviously you do. Managed assets, mutual funds, segregated funds, ETFs, and wrap accounts. What is a mutual fund? Well, it's a pooling of dollars from many investors. Investors buy units, but they can buy them either by the unit or more commonly, they'll say, I want $10,000 worth. They'll buy a dollar amount. Units are bought and sold each day at 4 p.m., which is the market close price, and at net asset value. The money is managed by professional money managers. Those professional money managers must follow the prospectus, which sets out the rules for investing and provide fee disclosure. The manager invests based on the criteria in the prospectus and is usually constrained by limitations also in the prospectus. One of the main attractions of mutual funds is professional management and very good liquidity. Mutual fund fees. This is a hot topic today. There's the management fee. There are administration fees. There's the trailer fee. This is the fee paid to the advisor for servicing the fund. Sometimes they have deferred sales charges or other load charges. They have trading costs and miscellaneous charges. Most of this is lumped in the management expense ratio. It's supposed to include all the fees. Very often does not include trading costs. So ask for the MER and ask if that is the whole fee for operating the fund. That's the first thing to ask for. So how do you buy mutual funds? Well, you can buy them from investment dealers, financial planners, banks, trust companies, discount brokers, and some other quasi-advisors. And what will it cost? Well, it depends. First of all, the fee to purchase. Some funds are available with a no-load feature. That means it's no fee to buy or sell the fund. Some have a front-end load or some other form of load of fee structure. The front-end load is 1 to 5% at the purchase, time of purchase, and no cost to sell. Low load and deferred sales charge are really one and the same. The difference is low load is a short DSC and typically has a 2.5% internal fee, hidden fee. You have to hold it for typically 3 years, and then it's free. It can be sold at no extra charge. Whereas a conventional deferred sales charge fund called back-end load funds typically have a 5% upfront fee to the advisor and typically operate with a 6-year declining balance. And it's not linear. The balance usually it starts off at a high level, tapers down to about 3%, and then goes to 0 in the last year. So usually a fairly onerous cost to sell if it's within the first 6 years. Most mutual funds pay a trailing commission to the advisor or a salesperson, typically 1% on front-end load funds and many no-load funds, and 0.5% on deferred sales charge funds. So, how should you purchase the mutual funds you're interested in? Well, let's start with looking at how mutual funds are assembled. First of all, management style. In equities, you find growth managers, sector rotators, and value managers. In fixed income, you find short managers that focus on short-term fixed income, some on mid-term fixed income, some on long-term, some are interest rate anticipators. In other words, they're trying to trade the fixed income securities they hold, and some are spread traders. Growth managers tend to buy stocks with high price-earnings ratios. Sector rotators tend to stress market timing. They pick sectors that are in favor, excluding reducing the holdings in sectors that are out of favor. Value equity managers try to buy stocks with low price earnings ratios. Now, index mutual funds are typically a basket of stocks that match an index. Usually they have lower management fees because they're not actively managed. The previous ones were actively managed. And embarrassingly for most managers, index funds often beat the returns of the bulk of money managers. It's hard to beat the market. Next, what are segregated funds? These are mutual funds sold by insurance companies, typically with what's called an insurance wrapper. Usually that insurance wrapper is a form of guarantee of return on investment. So 75%, typically might be 75% of the original investment after 10 years. So it protects against asset erosion. And in the case of death, either 75 or 100% guaranteed at that point. More and more, they're 75% and 75%. The ones that have 100% death benefit guarantee tend to be quite expensive. The MER may be 1% or even more than the regular mutual funds, so the insurance cost is quite significant as part of the return, as part of the piece that comes out of the returns. Who sells segregated funds? Investment advisors and insurance agents. So let's look at another type of fund. It's an insurance product. It's the 4% per year income plus investment. It's a form of variable rate annuity. It offers 4% guaranteed after age 65. And typically, if you buy it before age 65, it offers you a guaranteed rate of return to the portfolio, typically 4% again. If income's taken before 65, the guarantee is knocked down to 20 years. So the reason they say it's guaranteed for life after 65 is because 65 and 20 is 85, which is the approximate average life expectancy of most people. Money goes into segregated funds. The MER is quite stiff, typically 3.5%, sometimes even more, because you got the segregated fund MER, which is already likely to be 3% or more, plus the insurance rider that could be 60 or 80 basis points. If you get paid 4% with a 3.5% MER, the portfolio has to go up 7.5% a year just to break even. So that extra fee is a guarantee on the original invested dollars, and it means that the markets have to be quite good for the fund to do well. Inflation could hurt you. Another question you might have is, is the insurance company solid? Will it have a problem? These are the risks you have to consider. And as an investor, you probably shouldn't be expecting to get your money back. It's really more like a return of your money over time. At death, the estate's going to get the original investment, less the funds that have been paid out, less the fees that have been charged. So the only way the estate would get the original investment back is if there's been enough growth to cover the funds that have been withdrawn and all the fees. So does MER matter? You bet. It affects the returns directly because it comes off the top. There are thousands of mutual funds to choose from, and as you can see, it's very important to ask questions. What are ETFs? ETFs are exchange-traded funds. ETFs are bought and sold on the stock market. They kind of look like stocks. They trade at a discount or a premium to the net asset value. Usually, or let's say originally, ETFs mimicked indexes, bonds, etc. But there are now ETFs that cover commodities and/or portfolios. Some are even actively managed. The first ETFs were created in Canada. They were TIPS and HIPS on the TSX. Now, both the TIPS and the HIPS have been replaced by XIU, which is the TSX S&P I60. It clones the TSX S&P I60. Anyway, the good news about ETFs is they're very transparent, and they trade in the market, and at the end of the day, they settle up very close to net asset value. Usually, ETFs have fees much lower than mutual funds. The passive ones, there's a controversy over whether long-term returns are going to be better than professional management. Typically they are. Some are actively managed. If you end up buying actively managed ETFs, again, be very careful to ask about the fees. Some of them have quite heavy fees. Portfolio ETFs are the next generation of ETFs. They mimic portfolios. Typically, they're intended to have fees lower than mutual funds. The fees are hidden, so they're not tax deductible in open accounts. Some ETFs emulate wrap accounts, but at lower fees. So they're a modern alternative to mutual funds. And there are lots and lots of them, and more hitting the market all the time. Let's take an ETF example. Let's take the iShare S&P TSX Canadian Dividend ETF. This is designed to replicate the performance of the S&P TSX Canadian Dividend Aristocrats Index. The management fee is 60 basis points, in other words, 0.6%. It's listed on the TSX, the symbol is CDZ, and the top holdings, at least as of the summer of 2017, were Atlantic Power, AGF, Enbridge, Income, IGM Financial, Shaw, Cineplex, Keyera, Thomson Reuters, and Bank of Nova Scotia. Pays a dividend, 4.26%. That's as of November 2000. All this data is as of November 2016. So, if we look at the chart on page 22, let's compare an ETF to a mutual fund. Compare the Claymore US Fundamental Index ETF to the RBC US Equity Fund. You'll notice that for the exact same time period, 47 weeks in the January to November 2009 period, the RBC Equity Fund generated 7.25%. The US Fundamental Index generated 19.25%. What does this tell us? Well, it tells us that the index outperformed the manager significantly in this particular environment. But is that really fair? Well, it is, because the manager presumably could have picked any stocks they wanted to within the US index, and their objective and their expressed intent is to, the reason you want to buy that mutual fund with professional management is hopefully to outperform the index. In this case, it didn't do so. Let's look at another example. Let's take the Claymore S&P TSX Canadian Dividend ETF, which again has a 60 or 80 basis points management expense ratio, versus the RBC Canadian Dividend Fund, which is one of the largest dividend funds in Canada. Now here, you can see that the Canadian Dividend Fund, the RBC one, generated 18.25% for the period January 9, 2009 to November 2009. Over the same period of time, the Claymore S&P TSX Canadian Dividend Index ETF generated 19.75%. So the difference is 1.5%, which is very close to the difference in the fees between the two products. So let's look at wrap accounts now. They're a professionally managed investment plan. All fees are wrapped into a single annual fee, 1.25 to 3%. Accounts usually require a minimum size, and the main reason for going to wrap accounts over conventional mutual funds where the fees are all embedded is because the visible fee means that that fee becomes tax deductible. So at least part of the fees are tax deductible. In an open account, that's very attractive. The investor buys into a specific group of wrapped funds or managed portfolio securities. The investment dollars are allocated amongst asset classes depending on risk tolerance and needs of the investor. The choices of allocation, typically they can be 6 or more types of portfolios, and this allocation process can be achieved with mutual funds too. So what's the difference between a wrap account and just buying a collection of funds? Well, the wrap accounts tend to have lower fees, and like we said before, they're tax deductible. As well, it takes away the need for the investor to do much. The wrap account takes care of it. Basically, professional management is supposed to be absolving the investor of the need to make any investment decisions. The management portion of the wrap account should be tax deductible. As we said before, the management fees are not hidden, but obviously the MERs and the mutual funds are. And most wrap programs perform rebalancing of accounts to maintain the asset allocation goal, hence taking away the need for the investor to make too many investment decisions. Wrap accounts provide the investor lots of choice of managers, and you and your advisor can hire or fire the managers. Some wrap accounts have a manager that monitors the managers too. Typically that gets expensive because the more people involved, the more everybody has to make a little something off. There's a raging debate over the performance of wrap accounts versus mutual funds when you exclude the tax advantages, and the allocation method is usually restricted to a strategic model. Really, it is a glorified fee-efficient mutual fund account. Now, how should you buy wrap accounts? Well, ideally, if your advisor will do it, it'd be nice to have the funds in no-load format. The advisor receives a portion of the fees. The advisor helps monitor the manager and can initiate the switches. And wrap accounts are an alternative to a portfolio of mutual funds or a managed fund portfolio. How should an intelligent investor approach wrap accounts? Well, like we said before, they're great for hands-off approach to investing. They're very unlikely to exceed market returns over the long term, but they do provide good diversification, so there's some risk mitigation built into them. And it's a very simple approach to long-term savings in non-registered accounts. Now, the next idea is a unified account. This is a good alternative for investors who don't want to use individual stocks in a portfolio and prefer not to use mutual funds. Investors visualize individual securities in their account, leading to tax efficiency. It's great for passive investors again because the advisor takes care of everything. They tend to have fee efficiency, not duplicating, and some of these unified accounts also minimize the duplication of securities in a portfolio, which is good for the asset allocation strategies. And of course, the fact that the fees are visible makes them tax deductible, and tactical allocation can be practiced. That's the end of Session 10, Managed Accounts.